think those that have been patient, even in the painful times, are going to get the last laugh and the highest reward. It's still a fantastic value right now, but of course we're seeing it in spreads and the premiums as the world starts to turn more towards physical understanding and recognizing the weakness in holding precious metals in an ETF.
Hi, I'm Kaiser Johnson with Liberty in Finance, and this is the Miles Franklin Weekly Special for October 4th through October 11th, 2022. This week we feature a very special silver buffalo at only $4 over spot while this shipment lasts. These 1-ounce silver rounds are made by Bull Mint in Bulgaria, a mint distinguishing themselves by raising the bar not only on purity and quality, but on artistic merit. So you'll see that these are buffalo rounds reimagined, with 4/9 fine purity instead of the traditional 3, as well as a new portrait on the obverse and dueling bison on the reverse. They come in tubes of 20 and what Bull Mint calls master boxes of 400. Again, these rounds are available at $4 over spot for a very limited time. Our number for all orders is 1-888-81-LIBERTY. It's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend Matthew Piepenburg from Matterhorn Asset Management. Matthew, thank you so much for joining us today.
Great to be back, Elijah.
Well, it's great to have you. And I wanted to discuss first what is happening in the precious metal markets. It seems like this week we've had quite a bit of a rally, and we're hearing from, retailers and wholesalers across the industry that people are just buying precious metals hand over fist, the physical product. We're also seeing a lot of deliveries off of the COMEX. Your perspective just on this whole situation and what is driving it?
Yeah, Elijah, it's a loaded question. There's so many ways to address it. It always starts with the exchange rates and currencies and rates and debt markets. Obviously the 10-foot answer and the 30,000-foot answer is the strong dollar and what that has and how that impacts everything else in the system, from again, exchange rates to debt repayments to emerging markets to global perception to global angst. I think what we're seeing when people complain about the gold price in U.S. dollars is because when the U.S. dollar is strong, it pretty much crushes every asset class in its face, including precious metals. What's important to keep in mind, and is sometimes not kind of kept in mind by American audiences, in every other currency, gold has been doing quite well all year. The dollar has been incredibly strong, and there's an inverse correlation for a short period when the dollar is strong. When the Fed funds rates are up, as they are, as the Fed is tightening and as Powell is trying to become Volcker 2.0, when the Fed funds rates go up and rates are up, the dollar gets stronger. And of course, gold gets hit and everything else gets hit. But I think one of the clear answers is keep in mind that in every other currency, gold's been doing very well. I think in the British pound sterling, it just reached a recent all-time high. So when other currencies are getting shellacked by a strong dollar, I think the pound is at 37-year lows, the euro is at 20-year lows, the yen's at 50-year lows. All these other countries that have dollar-denominated debt or have central banks that have to try to follow central bank policies from the Fed just can't keep up. They can't raise rates at the same level. They have too much debt. They're not a world reserve currency, and they're strangled by this strong dollar policy. I joke with allies like the U.S. who needs enemies, because as usual, when the U.S. makes a decision, whether it's on sanctions or whether it's on interest rate hikes at the Fed, its allies in Western Europe have to follow, and its debtors in other countries and emerging markets have to debase their currencies to pay their debts. So there's a massive ripple effect, and everybody but the U.S. dollar is in pain. And when that pain comes in, when that emotion comes in, when that fear comes in, there's an allure for precious metals in general and gold in particular. Of course, with silver price, it's got a stronger inverse relationship with the strong dollar. But despite even that, silver is starting to slowly make its moves. I think there's a global perception of angst. There's a global perception that Fed policy, no matter how long Powell wants to try to tighten and pretend he's Volcker, which is madness, and we'll talk about that in a debt-soaked America. But in this short-term period of rising rates, every other currency is getting blistered. And so there's an attraction towards physical metals as real money, as a monetary commodity, as a monetary metal, not just as some type of investment hedge. And so the perception is clearly in favor of precious metals in pretty much every currency but the dollar. And so the question then is, how long can the dollar stay this strong? I also think there's just fear in the markets as derivative markets de-lever in a higher rate environment. The derivative markets contract, And you're seeing now as countries get more nervous about what is real money, what is real currency in a world gone fiat, certainly gold is looking more realistic. And so you're seeing more contracts on the COMEX market actually taking delivery instead of playing this pretend game of chicken where you pretend to buy, I pretend to sell, and we'll pretend to deliver. It's just a churn to keep the prices kind of stable or fixed. Now there are actually thousands of contracts in the COMEX market which actually want delivery. I think what's happening, you saw the Bank of International Settlements kind of delever its swap book, and then you saw JP Morgan and Citibank massively uptick their derivatives book in precious metals. I think the smart banks are trying to keep the gold price down in US dollars as much as they can so that they can actually take delivery at a discount and actually get that physical gold. So I think they see down the road, whether it's 1 or 2 years or sooner, that real gold and physical gold is going to be an undeniably strong asset. And so they're effectively wanting to get delivery physically now. And so between this strong dollar policy, changes in the derivative markets, emotional fear, because gold is very emotional, and what's happening in the COMEX, gold is very popular now for central banks and for investors and for institutions and for commercial banks. So it's a great opportunity right now to repress the price on the COMEX and then take physical delivery so that they have as much as they can get before the whole world is looking for what is otherwise a very scarce asset.
You mentioned how most of the time the traders on the COMEX kind of play a game where, no one really takes delivery, but now that's changing. Do you think this is going to put stress on the physical market? I know at least for wholesalers and retailers, we're already seeing that when we're looking at retail product like the bars and rounds, but your perspective on that, like the larger system in general, will that really put pressure on physical metal?
Of course. I mean, we're seeing it. We only deal in physical metals. And so we're looking at that. Again, we have larger institutional or high net worth clients. We're buying larger volumes, but you're seeing the premiums. You're seeing that in the premiums. And certainly at the retail level, whether it's small bars or coins, premiums are going to reflect the scarcity and the higher demand. And so, again, it doesn't mean it's too late for those who've been patient and seeing gold as what it is, which is real money and as an alternative to fiat, not just a speculative asset. I think those that have been patient, even in the painful times, are going to get the last laugh and the highest reward. It's still a fantastic value right now, but of course we're seeing it in the spreads and the premiums as the world starts to turn more towards physical understanding and recognizing the weakness in holding precious metals in an ETF, or even frankly, physical gold in a commercial bank, where most of that gold is hypothecated. For those that own physical gold and looking for whether it's a coin or a bar or a kilogram, there's more sophistication, but there's also higher premiums right now as there's more demand for an inherently scarce asset.
That's definitely true. And it seems like it could only get worse from here or the demand could only increase from here, because if we look at like the percentage of people in the world who are actually invested in physical precious metals, it's nothing. And I know Rick Rule has pointed out that, if we just go back to the average, it's, probably triple at least from here.
Oh, look, I mean, it's 0.5% of global assets are held in physical gold. It's the scarcest asset on the block, but that scarcity was laughed at for years, but we always get the last laugh. I mean, it's basic supply and demand principles. And again, I don't want to get unsophisticated, but gold is an emotional asset. When fear rises, when faith falls as fear climbs, as faith in the system, whether it's the central banking system, the commercial banking system, the fiat system, the political systems, left, right, or center, when that faith starts to fall, the emotions toward gold start to get more and more high, and people start to become a little more sophisticated. And look at markets right now. You've got, the S&P down well past 20. You've got the NASDAQ 100 acting like it did around the 2008 crisis or the 2000 crisis. You've got mortgage rates now at 7%, just under 7%. So you've got a housing bubble that's definitely coming to an end. You're going to have layoffs in mortgage refinancing or mortgage sourcing. You're going to see layoffs in industries. And you've got, hundreds of companies in the publicly traded markets, which are effectively zombie enterprises with, billion-dollar market caps and no free cash flow, no earnings, no balance sheet. So a lot of these overpriced zombies are going to tank, and the markets have not even come close to a bottom yet. So this is kind of pretty much self-aware now for anyone following markets, the risk asset markets. 60-40 portfolios are at their worst since 1931. So there's no place to hide anymore. And there's a perception that you can still hide in the US dollar, but that strength too is only temporary, and it's only correlated to Powell's policies, which are not sustainable. So there really literally is no place to hide your currency, hide your assets, or hide your investments I'm not saying gold is the only solution to the current disaster in the global macro environment, but it's clearly going to get more and more attention as things get weaker and weaker, from Credit Suisse to this risk assets to political risk or geopolitical risk. So it's a fascinating time, and I think that emotional aspect and the backdrop of a market that hasn't nearly found its bottom, and a central bank in the U.S., which has control of the world reserve currency, consistently trying to act tougher than it is. It's an absolute fantasy to think that even a 5% Fed funds rate is going to beat 8 to 9% persistent inflation. So you have to ask, this idea that you can use old tools to fix new problems. It's just a disconnect between what Powell is saying, what the real world and the real debt scenarios are. At our debt levels, we can't afford a 9 or 8% interest rate to defeat inflation. So what is Powell really doing? What Powell is really doing is he knows that we're in a recession, not officially. We're going to be in one. The more he can jack up interest rates now, or the Fed funds rates now, the more he can look tight or look aggressive or hawkish or Powell-like, the more tools he'll have, or the more ammunition he'll have to actually cut rates when it's beyond repair, when the systems are totally breaking down. He tried to do this in 2018. He tried to raise the rates every quarter, a certain amount, 25 bips, 50 bips. And then the markets tanked at the end of 2018, and then they had to pause by 2019. What he's trying to do now is the same thing he tried to do in 2018, which is give as much ammunition as he can with higher rates so he'll have anything to lower when this recession becomes undeniable. Again, this fantasy, this fiction that it's about a fight against inflation, again, I'll keep reminding, when Powell did that in 1980, we had 900 million in public debt. Now we have over 30 trillion. You simply can't do this. And what we've seen in the UK is they called the bluff. They can't raise rates and not print money to pay for it. They can't cut taxes. And if they're not going to cut spending, they're going to have to come up with that money somewhere. Since it's not coming from GDP, it's going to come from a mouse click. And so I still think that's inevitable with the Fed. It's just a question of how long they're going to let Main Street suffer, basically, after creating the greatest wealth disparity in history, pumping QE into a market that doesn't trickle down to everybody. At some point, how long are they going to let Main Street suffer through higher inflation and higher rates and layoffs and higher unemployment and in a housing market that's going to get bent? So all of these things are going to happen. At some point, the world cries uncle. The Fed will have to come up with some type of pivot. There's just no doubt in my mind. They're just not doing it right now, and they're going to let middle-class America suffer for as long as they can after helping the top 10% get the greatest wealth ever accumulated in our history. It's really astounding. It's astounding.
It definitely is. And I've heard the perspective that when that happens, when the Fed pivots, it's not going to be, the impact is not going to be like it was before, where a lot of that money goes into the stock market to reinflate the stock market. That story is over. What I've heard is that it'll actually move more into real assets and precious metals, and we'll continue to see a stock market crash. Your perspective on that?
Well, Elijah, I completely agree. I mean, it's a crude analogy, but it's a true analogy. It is like addiction. It's a form of alcohol or a drug addiction. I was doing a presentation in Germany about the Suchtmittel. It's an addiction. And like any addiction, you can drink more and more when when your body's gotten used to it. But at some point, it doesn't have any effect. In other words, you need 12 martinis to get what would take you or I one martini to get a nice little buzz. So we've been drinking so many martinis with mouse click money and printed money. The markets have gotten so used to that and priced that in. But the dilution factor of the power of that martini after so many years of addiction, that martini is now like water. Our currency, despite the DXY and despite a relatively strong dollar compared to every other dying currency, is still weak. The purchasing power, the inherent purchasing power of the dollar measured against a milligram of gold continues to fall. And so when they do pivot, and the markets will temporarily get euphoric over more QE, but that's the debt trap the Fed is in. If they don't pivot, we just get a massive financial crisis globally and a global recession that becomes a depression. If they do pivot, markets will rally on a weaker, debased dollar, and you'll have super inflation anyway. There's just no way around it. They're going to debase the currency if they print more, or they're going to stay tough and stay tight and stay hawkish and just send the markets and the economy into a trap that they can't get out of. So the Fed's cornered. And I think more QE will be temporarily euphoric and then long-term disastrous for currencies, including the US dollar. And no matter what this relative strength is of the dollar versus a yen that's been completely handicapped, or a euro or won or other currencies that are getting blistered, it's still going to be weaker and weaker purchasing power. And that's, again, when monetary metals, that unappreciated, unloved, laughed at, scarce asset, really does get the last laugh. And as far as I'm concerned, it's getting the last laugh right now. It's already happened. It's been happening, frankly, since 1971. But, the private wealth management desks at Goldman Sachs, Barclays, and elsewhere just poo-poo gold because they can't get commissions on it. They can't churn it in the same way and can't make the same profits. So they've always, in Wall Street, made a fun of what is the singular asset I think is going to get the most attention in the next 10 years.
No, when it comes to what is happening in the financial system right now and also internationally, where you are in Switzerland, we're seeing a crisis with Credit Suisse. Your perspective on that and how that could reverberate throughout the system?
It's a tired analogy. It's a great question. This is a Lehman 2.0 moment. We all remember Lehman back in 2008. I had close friends very high up at Lehman when that was happening. And it's a back to the future kind of pattern that's very all too familiar. Lehman was a bank that had been around since the 1850s. It was a strong bank at the time. It took about 9 months from peak to trough. In other words, from euphoria to madness. I remember in October of 2007, there was already, just like we're seeing in this year, already, cracks in the armor of the global financial system in the U.S. markets, just like we're seeing this year. Markets were falling. There was stress. There was concern. And then by 2008, by September, Lehman was completely toast. But up between that period, it's important to remember that Lehman was no different in its net leverage numbers than Goldman Sachs or Morgan Stanley, banks that later survived. And they were, a little bit worried about their leverage. But when you look at the times, when you look at 08 prior to September, it really wasn't that much different than other big banks that survived. The problem was there was a perception crisis and there was an underlying asset crisis that you saw at Lehman, just like you're seeing at Credit Suisse. Right now, Credit Suisse has admitted that they have some restructuring to do, but they have to raise capital. With the stock price is falling 70% since February, because their underlying problem is the same as Lehman's: too much leverage, and their underlying assets aren't strong assets. And there's a perception now in the market that the stock that's fall from its highs in February to 70% less lows now. That makes it harder to raise capital. And what's equally important, I think, about the Lehman comparison to, say, Credit Suisse today, just like Lehman was Lehman was neck to neck, shoulder to shoulder with other pretty dangerous banks that had sinned with leverage and sinned with their subprime exposure and sinned with their debt and credit books and sinned with their balance sheet announcements. Credit Suisse today is hardly any worse than Deutsche Bank or other large banks in Europe or in the US. European banks are more delevered levered. They're 20 times levered than, say, US banks, which are about 10 times levered, because they've had negative real rates for so long in Europe. The truth is, Credit Suisse is the most famous bad horse in the glue factory right now, but they're neck and neck with other bad horses, just like Lehman was in 08 with Goldman, Morgan, Citi, and others. Their books were terrible. But what's happening now, like you saw in Lehman, is the credit default swap pricing, price you paid. And when credit default swaps are, for those who don't know, that's an asset you buy if you think something's going to tank. So you buy a credit default swap like insurance. You buy a credit default swap against subprime. As subprime tanks, your credit default swap has value. Well, you can buy credit default swaps for banks too. And when Lehman was starting to have its problems in 07, 08, credit default swaps, I think, were priced at 40. They went to 400. Right now, this year, you've seen credit default swaps for Credit Suisse go from about 50 to 250. So the markets are pricing in high risk for Credit Suisse. It's going to be very hard for Credit Suisse to issue bonds and recapitalize when credit default swaps are so high. The market and the world is saying we don't trust Credit Suisse. Rightly or wrongly, they're getting more attention than, say, Deutsche Bank. But the problem, the inherent sickness in these over-levered banks who have, 10% capital to whenever, they have the same joke way of doing, fractional reserve banking as the U.S. does. They're so over-levered and there's so little capital deposits in them that Credit Suisse is just getting the most attention now. I think we're going to see fracturing the banking system throughout within Europe and the U.S. Not the end of banking systems, but a lot of distrust and a lot of failed banking systems that are going to have to get some kind of salvation again from a sovereign entity or some type of bailout again. And I think the world's not ready for another 2008 bailout for big banks. But I hate to say, in some ways, they are too big to fail. But the way they're run and the way they're capitalized is going to change in the next couple of years, I'm sure. And Credit Suisse is just the first of the dominoes, I think, to fall here in Europe, which will then track into the U.S. markets and U.S. banks as well.
And the end game of that, it seems like, would be an inflationary scenario if we just see bailouts coming to them.
There's no way around it. Again, you can have disinflationary periods. If the markets lose 50 or 60% from their highs, which is a mean reversion, which is entirely likely, that's inherently disinflationary. If you have a recession, if Powell forces us into a recession, which he's clearly engineering, just like he engineered the greatest risk asset bubble, him and Bernanke and Yellen and others, they engineered a bubble, they'll engineer a recession. A recession, when there's lower demand, is also disinflationary. But the only way out of this is to weaken the dollar and weaken the currency and to print more money. So you've got these competing forces of inflation and disinflation. The end result, though, is, in my opinion, stagflation. We're still going to have supply shocks from overseas and from Asia, whether it's geopolitical risk from the wars or tensions with China. Remember, we had a trade war with China before we had a war with Putin, a proxy war with Putin in the Ukraine. So there's all types of supply shocks that are going to influence inflation. You're going to have disinflationary forces in the markets and in housing markets and in a recession. But these supply shocks combined with the combined money supply that's been growing since we started discovering the money printers in volume since 2008, you're having inflation and disinflationary forces combining. I think ultimately we're going to see the worst of it all, which is stagflation. Could be wrong, but I see disinflationary forces for sure between falling markets, falling housing markets, and certainly a recession. That's disinflationary. But the QE that's going to come and the QE that's already been doesn't just go away. It doesn't go to money heaven. Its inflationary forces are still out there. So I see a period of stagflation. I certainly don't see rising rates stopping that. Again, my thesis, and it could be wrong, but it's my strong thesis, is that Powell is being a politician because the central bank isn't independent. It's a political entity, and central bankers talk like politicians, which means they don't tell transparent truth. They have to be positive all the time, or they have to be disingenuous to keep the narrative going. But my opinion is that Powell is simply raising rates so they'll have something to cut. He has no intention this is going to create a Volcker-like scenario. But even in 1980, when Volcker raised rates to 20%, we still had a recession. But you will not have a soft landing when inflation's over 5%. You just won't. We never have, and we never will. And even Powell is now calling it a softish landing with some pain. I think that's really rich of Powell to say some pain or a softish landing. Because for the top 10% of the U.S. population, which has been the sole beneficiary of this asset bubble that he created, it'll be hurtful, but it won't be crippling. It's going to be crippling for the middle class and for regular Joe Sixpacks who've done everything, pay their taxes, go to work, and try to get by month to month, week to week. They're the ones that are going to suffer the most during a recession. They're the ones that are going to suffer the most during inflation and stagflation. And so for Powell to say it's going to be maybe a softish landing with some pain, it's really going to be pain for the middle class, which the central banks have always ignored. Always. The Fed wasn't designed for the middle class. It was designed for a cabal of bankers in Wall Street. So I think as more and more people see that's not sensational, that's just historical, empirical fact, they're going to get more and more upset, more and more angry with their central bankers and the politicians who have been lobbied by or for or with them. It's just not a fair entity. It just isn't. And so, yeah, stagflation is how I see it, and it's going to hurt one class of people far more than the others.
If we can hone into what we're seeing right now, again, with the strong dollar, you recently wrote an article on this, and you said that the strong dollar will really lead to an implosion. It could be a systemic implosion for the financial system. What are you seeing right now, right there? And what is the breaking point for this? Because recently we just have seen kind of a vertical move in the dollar. We saw pullback this week, but it seems like it's going parabolic right now.
Yeah, I think central bankers, either academically or in their kind of glass chambers, just don't see the real world, not only outside of their window, but outside of the borders of their own country. There's almost $14 trillion worth of dollar-denominated debt, not necessarily owed to commercial banks in the U.S., but there's trillions of dollars in U.S. dollar-denominated debt owed by countries like Sri Lanka or Lebanon or Turkey or Venezuela or Argentina. And these emerging market economies are absolutely strangled, and they have to pay back dollar-denominated debt in their currencies. They have to convert that currency, or they have to, in the case of Japan or the UK, sell U.S. treasuries to come up with more dollars to pay off some of these debts. So there's a breaking point at some point, whether it's developed economies like Japan and the UK, which are allies of the US that really doesn't care about their currencies, or whether they're emerging market countries like Argentina, who has a 70% interest rate right now. They've had to follow for years the lead of central bank bullies like the Fed. to when the Fed prints money, then the banks in Argentina, South America, have to print money to pay back the debt. It's a vicious circle. It's like what they call the Confessions of an Economic Hitman. That was a great book that came out years ago. This idea that what the Fed does has massive ramifications for other countries, developed and developing. And in what's happened in the third world economies or in developed economies is they're straddled by this U.S. dollar and annual debt. And as the dollar gets stronger and stronger, there is a breaking point. Which is why you're seeing all these kind of new agreements with the BRICS and Russia and China, because they're slowly transitioning from this dollar-led world reserve currency monopolar system to a multipolar, multi-currency, multi-exchange system. Again, that's not going to happen overnight or by next Tuesday. It's a slow process, but there's a seismic shift happening in 2022, which I think is and Grant Williams, our colleague, said the same thing. I think what's happening in 2022, post-sanction, post-SWIFT, post-dollar, is as big a watershed as what happened in August of 1971 when we got off the gold standard. Massive changes are going to unfold. And, you're seeing this unfold quickly. And again, whether it happens overnight is not going to happen. It's like Hemingway's definition of poverty. It's slow and then all at once, which is what happened with Lehman. It was slow and then all at once. If it happens to Credit Suisse, it'll be slow and then all at once. The question now is, it's impossible for me or anyone else to say it's going to be done by December 13th, or it's going to be January 22nd, or early in Q2 or Q3 of 2023. No one knows. But you certainly know when it's raining, you need an umbrella. And whether it rains at noon or at 3 p.m., you have to have that umbrella. And I certainly see precious metals as one of the strongest, not the only, but one of the most obvious umbrellas that people can grab. And we're seeing that now, again, from the COMEX markets to retail sales of coins, to small bars, to large bars in Switzerland. You're seeing a deep desire, especially at these prices, for smart money to find that umbrella, which is real money. JP Morgan said it. The rest is just debt. Gold is real money. It's not an apology for a gold bug. It's just the way history and math move. And I'm glad that more and more people are starting to see this, because for our clients or our investors, I'm sure yours, yes, it hurts to see gold go from 2000 to 17 or 16 and then go from 16. It feels great when it goes to 22, 23. For our clients, the daily price, the strong dollar influences are all temporary. The trend is clearly in favor of precious metals right now. And if anything, this is a super buying opportunity, even with the premiums because of the scarcity of the metal.
All right. Well, Matthew, we really appreciate your time today. It definitely does seem like a very interesting environment we're seeing, especially in the precious metals space, as we see this strong dollar and then it weakening and markets really in turmoil right now. But before we let you go, where can our viewers find you if they want to keep up with your work?
Sure. All of our articles are published on goldswitzerland.com. It's Matterhorn Asset Management is the name of our group, but there's a whole section where Egon von Greyer's and myself and some articles by Ronnie Sturfel come in, but my articles are all there, and just goldswitzerland.com.
All right. Once again, Matthew, thank you so much for your time, and God bless.
Thank you, Elijah. It's always a pleasure.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.